Welcome to Unfiltered Finance. I'm your host, Emily Turner, and joining us today is Geof Smith, who knows quite a bit about hedging, and one in particular, which we will get to in just a moment. But just to set the stage, the current market has made traditional hedges, bonds, gold, that kind of thing, perhaps a little less reliable. So, Geof, what do you see going on here? What is it?
Well, right now, we've got a lot of different, outside geopolitical forces, I'll put it that way, and AI, kind of messing around in these markets and everything like that. And I think one thing that, I've noticed is when you look at, a market and everything is down, it's kind of hard to look to hedging when that happens. But another thing is what's going up. I mean, right now everybody's seeing oil going higher, energy is going higher, right? So are you going to use that as your hedge against the other markets? I mean, that's a legitimate thought. But when you're seeing everything moving like this, I think there's a lot of fear in the market right now. The market doesn't like uncertainty. People don't like uncertainty. I mean, we want to know what's happening next week or tomorrow or whatever it is. Well, the market's the same way, but it looks 3 to 5, 6 months out. And if it can't make a clear picture, that's worry in the market. And the market has a tendency to be very volatile and be, kind of moving down off of that because they don't like the uncertainty.
Yeah, I mean, it's been interesting because traditional hedging, it used to be, all right, I'll throw some money in bonds, I'll throw some money in gold, I'll call it a day. That is not necessarily the best play today and age.
No, no, I think the wisest decision, if you have a portfolio, let's kind of start there first. If you have a portfolio of stocks, I think one of the best way to do is just to buy, I'm going to call it insurance. How's that? Everybody buys insurance on their cars, their houses, whatever. Why not buy insurance on your portfolio as well? And what I'm saying is look at the stocks that you have in there. And there's a couple of ways of doing this, and we can discuss all of them. But one is do you just want to say, well, most of my stocks are, the big blue chip S&P 500 stocks? Or are you the type of person that likes a little more risk and say, well, most of my stocks are NASDAQ stocks, kind of thing. So I would look at those and say, well, what's my majority? And maybe use like the QQQ, the ETF, or the SPY, the ETF, and use those for your hedging. You can buy puts on those, and there's a lot of different strategies that you can use on that. Or even more specific is, well, most of my stocks are doing okay, but I have a couple that I'm worried about. Why not just go and buy some puts on that individual stock? And that way, if it does drop off drastically, at least you're making money on the put to offset the loss on the stock. Um, Now, one thing that is I that people have a hard time with are options. I'm not going to disagree with that one bit. I mean, it's like either you get them or you don't. It's one of those kind of things. It's not, I got, no, I kind of understand those. It's usually, yeah, I understand those. No, I don't understand those. So, and that's what you're doing when you're buying a put option. You're actually buying the right to sell your stock. That's all you're doing. You're buying that right. You don't have to, you're not obligated for it. You have a right to do it. And so, what I always like to have is the right to sell my stock. But usually, you'll make more money on just buying the option and selling the option back as it goes up in price, as opposed to actually exercising it. But if you want to exercise it, you can, and it will sell the stock at whatever strike price you have. So there are those ways of doing it. I myself have a tendency just to use the SPY or the QQQ for my hedging of my portfolio, just because I don't want to have to go out and buy a whole bunch of options on a whole bunch of stocks. I mean, that's what you're running into. And the way to really think about when you're looking at, well, how many options do you buy on the SPY, right? I mean, that's the one thing you have to ask yourself, how many do I buy? Well, the SPY controls 100 shares of the actual stock, the SPY stock. That's what the option does. It controls 100 shares. So if the SPY right now is trading at, let's just say, $655 a share, times 100 is what? $65,500, right? So with one option, you're controlling $65,000 in stock. You are. That's what you're doing. Now, depending on the size of your portfolio, if you have a $50,000 portfolio, well, one option is going to be just fine for you. You can hedge that. The problem is when you look at the options, is what option to buy. And options can get very expensive, especially in the volatility that we've had right now, correct? I mean, the market is all over the place. I mean, the S&P is moving 150 points in a day right now, which is crazy. I mean, the NASDAQ's moving over almost 600 points in the day. I mean, that's just nuts. So you got to sit there and think, well, they're going to ask a whole lot more in the premium for that option. And if you look at, like, like I said, if the SPY is trading at 655 and you just buy a 655 put, it'll cost you $1,200 for that one put. I mean, that's very, very expensive. So what I like to do is usually go out about, 60, 70 points, what we call out of the money. In other words, below the market. So instead of doing it like a 655 put, you're buying like a 620 put. And that way it's a whole lot cheaper. And what I'll do then is for every 50, 60,000, I'll buy two options. And the reason why I do that is if the market settles basically at the money, your delta on that's going to be 0.5, which is half of a dollar, if you will. The option can never have a delta over 1, which is 1 point for every 1 point in the underlier. So if I buy an at the money option at 50, I have to have 0.5, 0.5 times 2 is what? 1, right? So I buy two options just because if it does drop, those options are going to increase and eventually be 1-to-1 with the underlying stock. But I do it out of the money just because, A, I don't want to spend a whole lot of money. Nobody likes to buy a whole bunch of insurance, right? So I try to, go way out of the money and try to find options that are somewhere between $1 and $1.50. So it costs me $100 to $150 for that one option that's controlling $65,000 in stock. And if I buy two of them, now I have basically 120,000, but the delta is going to increase as it drops. So I have those cheap insurance for a couple of $100 there. And if it drops, it drops. If it doesn't drop, it's only a couple of $100, just like every year. You got to buy an insurance because you didn't exercise your insurance, right? You didn't, have to fix your car. You didn't have anybody back into your garage door and you have to have, the insurance fix it or whatever it may be. You didn't exercise your insurance, so you just let those go. And if they expire worthless, fine. It was insurance. That's how you have to look at it. I wouldn't worry about that, the price of it. But if the market drops really hard, those put options are going to help your portfolio a lot because even though you might be down 2 or 3%, I'd rather be down 2 or 3% than 10 or 12%.
Yeah,
That's the big thing.
absolutely. So
And
my
so,
question for you though quickly is
uh-huh,
when you're looking at picking the expiration, are you picking a short one or are you picking the furthest one out?
I not the furthest out, but I'll go out probably 2 months just so that you don't have time decay. And that's the problem with options. You do have time decay. So, but if it drops, and they call that theta, if you want the little Greek thing, they call it theta decay. But if it does drop in a short period of time, you'll maintain the time value in it. And so it'll just increase in intrinsic value or just, basically the time value, the extrinsic value. So I do like to go out a couple of months. And just like last month, I was kind of warning people, hey, March might be negative. Just beware of that. So last month, I went to April, 2 months, and bought some SPY puts just in case. Well, look at the market now. It's sold off. But I did it for insurance. And that's what you do. You just put those out there and let it die. And if it dies, great. If it doesn't, if the market just turns around and rallies, fine. It was just insurance. And that's
That's
all
not
you.
your only hedge that you use.
Well, no, I'm a trader. So that's not a fair question. Yeah, I can do all kinds of stuff in a market. I mean, I'm like long crude oil right now just because I think it's going up. Well, it's been going up. I mean, we were at $65. We're now at $92. Of course, it's been up to 119, right? And it's pulled back. But that's the thing. I mean, I do use other markets. I mean, I trade lean hogs. I trade corn and wheat and soybeans and crude gold and all that stuff. I think, I mean, a lot of people have been quote unquote worried about gold, as especially as a hedge. I don't think there's any worry whatsoever. If you want to buy gold as a hedge, do it. Buy GLD. And if you're going to do options, I'd do longer term options. I'd do 3, 4 months out on the options if you're an option trader. But if
Or
you're
gold.
buying on gold
Yeah.
or on GLD, the ETF, or even if you want to do gold futures, that's fine too. That's getting a little, risky and everything like that, just because, it's a leveraged instrument. But I mean, I would go out longer term. Eventually, I mean, the world banks right now are still buying up gold hand over fist at a rate that we've never seen before. And I mean, right now, that's not being reflected in the market. Right now, what's happening is gold is trading along with quote unquote interest rates against interest rates. Interest rates are going up, gold's going down, bonds are going down. So if you want to say bond price and gold are going in the same direction, that is very accurate right now, just because everybody's running to the dollar. When interest rates are up, people run to the dollar. Well, the dollar is not that great of a currency, in my opinion, just because they keep just liquidating it. I mean, you look at our debt, $39 trillion right now. And it was 35 trillion. Now it's 39 trillion. Think it's going to be 40 by the election, this fall. So it's getting worse. And the only way to offset, the dollar being devalued is to buy gold, silver, and all that. So I think reality will eventually come back into gold and silver going, oh, well, nothing's really changed. We just had a war. And we need to jump back into an actual solid real asset. And
So is currency trading a hedge in your opinion at all, or just not the dollar?
well, now, hold on. So the dollar is, well, the only way to trade the dollar is based off the dollar index, which is a basket of currencies versus the dollar, right? So, and I don't like, my opinion, I don't like Forex. Forex is run by banks. I don't care for, to me, banks and lawyers are in the same group. I don't like either one of them, but you got to use them if you got to use them, right? So that's the thing about banks and lawyers. But if you look at the ETFs, the FXE and the FXC and stuff like that, that is a single currency based off the US dollar, and it's easier to trade those. Yes, you can use those as a hedge against the dollar. So if the dollar is going down, if you buy FXE, you're saying, hey, I think the euro is going to go up against the dollar. And if it does, great. So you can use those ETFs against that, the dollar itself. The dollar index used to be a very, very large index because the euro hasn't been around, but what, 25 years, 30 years, right? So we used to have the French franc and the Deutsche Mark, and we had all of those. Well, now they're all in one basket called the euro, except for the Swiss franc because it's still Switzerland, right? So that basket got smaller. So now it's only got like 6 or 7 currencies in that basket as opposed to all the European currencies plus, Canada and Japan and all that good stuff, Australian dollar, New Zealand dollar, and all that. So we now can look at that dollar index and say, based off world currencies, it's like this. But you can trade the FXE, FXC, FXB for all of those just one currency against the dollar. And usually you'll have, when the dollar is going down, those will all go up because it's all based off that dollar, right? Or if the dollar is going up, those will correct back down. But I think just against the dollar, I think right now is a good time for longer term to buy some FXE and FXC and probably FXB, and hedge your portfolio against your dollar devaluing.
So then is the time of this traditional 60/40 portfolio long gone?
Um, well, I'm not going to say outright yes. But yeah,
But a
I
lot
would
of
say
us
that
are
I would.
changing up that ratio now.
You are changing up that ratio. The problem is you can't say, well, traditionally I'm going to have 40% in bonds and 60% in the market, and I can always have that hedge in there. Markets, I hate to use the word evolve, but they evolve and they do change. I mean, if you look at just go back and take out all the political fluff and everything like that in the world, and just go back to traditional markets. When bond prices go up, that means interest rates are going down. And usually that happens because the economy is not doing too well. So they lower rates to get more buying into the economy, right? Well, when you have a roaring economy, they raise rates to cool down the economy because it's moving up too fast because you get inflation and stuff like that. So they raise rates to offset that. And that means that's a good economy. So bond prices go down, interest rates go up. And usually in a very good economy, what? Companies do well. So as bonds are coming down, usually the S&P, the Dow, the NASDAQ, they're all rallying up a storm because we have a great economy going on. And vice versa. When bonds are going up and interest rates are coming down, usually the markets come down because, well, we have a bad economy. Now that doesn't really matter.
Yeah,
I
the
mean,
correlation is very different now.
exactly. And so now we have an economy that, well, it's not roaring, but it's not doing real bad. Our problem is right now is you have to almost think of the old school petrodollar because everything in the world works off crude oil. It does not matter what it is. Anything that you can see in your house or what's on your body, clothes,
Yeah.
oil has touched it some way, somehow, some shape or form. The more expensive that is, the more things cost. The more it costs to ship it, the more it costs to make it. So when you have that happening, we have increase in prices. If we have increase in prices of all of that, what's happening? We have inflation. And inflation, what do interest rates do? Interest rates go up. So we have bond prices dumping off. We have interest rates going up because we have an expensive petrodollar, if you will. The crude oil market is moving higher. And you've heard Trump. I want crude oil down at 45, $50. Because he wants it low. Why? He wants everything cheaper for the American people, which is I don't disagree with that. Problem is, one person can't do that. You can't, crude oil is a global commodity. One person saying, I want it cheap, ain't gonna work. And then let's go just no, let's go bomb the Middle East where well 25-30% of all of our crude oil comes from anyway in the world. So that just, and of course Venezuela as well, we took that one out. So he's disrupting the one thing that he wants to go down. That doesn't work very well. And so you have that moving higher. So he's fighting himself, in my opinion.
Right.
So
So
and
when it
it's not
comes
going
to
to work.
all of these traditional tenets that people looked at, like the stock to bond correlation and all of these, I mean, what does someone really even cling to at this point when they're looking at how they want to hedge?
You,
What are the
well,
truths?
yeah. The last thing I would do is listen to somebody on CNBC or Bloomberg or anything like that, because they're still going to be touting that. And I think that's wrong. I think the way you use this market or invest in this market, trade this market, there's nothing wrong with looking at a stock and saying, I really like AT&T, I'm buying AT&T. Fine, buy it. But if you're going to do that, I'd probably just go out and buy a put just in case it didn't work. And that's the way you have to look at it, especially in a market like this. You can, I mean, if you look at the current, if you look at it intraday, I know most people don't. I get that. They work all day long. When they're coming home, they hear, hey, the Dow's down 215 points today, or the Dow's up 600 points today, whatever it may be. But if you every time the market starts moving higher, if you just sold that market, it'd go down and you'd make money. And every time it went down, if you bought it, it would go up. That kind of market is hard to trade in. It's difficult. The bulls and the bears right now are just at each other's necks, tooth and nail. And people don't realize this. There are bulls in the market and there are bears in the market, and they hate each other. It is it is the biggest rivalry you will ever see. And at the end of the day, they always like to stomp on the other one's head, going, "Ha, I won." And that's the way it is. And they fight all the time. That's how markets move. That's where we get bid and ask. You have bulls and bears. And that bid and ask is, well, what makes a market? You can buy and sell inside of that market. And so that's one thing you have to be very, very careful of. There are stocks, good stocks, that are going up right now. And there are stocks, good stocks, that are going down right now. And I think one of the easiest ways to help people to say, well, what is moving up and what is moving down? There, there's a lot of stuff you can look at on the internet. Don't get me wrong. And one thing that I would probably point somebody to is maybe going to a website called FinViz. I don't know if anybody's heard of that. A lot of people have, but go to FinViz. They have a free scanner. And if you just look at the fundamental stuff on there, hey, you want things above the 50-day moving average, above the 200-day moving average, right? You want some volume in the thing, so make sure you have at least 1 million shares traded a day. And then you can actually tell it, hey, I want it to be above $50 a share, or above $100 a share, or above $20 a share. You can choose whatever price you want. And if you would just do that alone, and then say, okay, find me those stocks that are up. It will. It's a real simple thing. You just click a couple of buttons and go, okay, do that. And there it is. And if you only have 3 or 4 stocks to show up in there, guess what? Most everything is down. There it is. And it's a real fast indicator of, is anything up or down? And that's what it does. I've got quite a few scanners I look at, but what worries me is when I go, okay, look, let me see all the bullish ones, and there's like 1 or 2 of them, and you go, okay, let me see the bearish ones, and you see that there's 50 of those. Well, that tells you one thing: stocks aren't doing well. It's a real fast indicator of, are things going up or are things going down? When things are going down, buy some puts. And when things are going up, save the money on the insurance, let the portfolio run. Another thing I would really, really, tell people is always, always, always step back and look at the whole forest instead of a couple of trees. You think about this real quickly. Right now, the S&P is down from open of the year, from when we started the year, it's down about 4%. It was up 25% last year. So when everybody's out there screaming how bad their portfolio is looking, well, it's really not that bad. If you look at last year, you had a good year. They just ran. Think about this, 25%. What is the average year in the S&P? What, 10%? Right? And we just had 2.5, years in the S&P in 1 year. So when everybody sits there and goes, well, okay, thinking of it like a track race, they just ran the 400-meter in under 4 minutes. So, or under 3 minutes. I guess it's 3 minutes nowadays. Who knows? And now you're asking them to do it again immediately. No, 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 no. They got to get some Gatorade. They got to sit down and rest, get in the shade a little bit, catch their breath before they go again. And I think that's exactly what you're seeing. We had a huge run last year. They're taking a breather, which they ought to. And they've got a lot of, they do have a lot of kind of uncertainty out there with the battles that the U.S. has started, and hacking people off and bombing and stuff like that. So there's that out there. But I think more than anything, this market needed a breather. And people only want to look at, today on the digital crack device here. And they want to look at today. They want to look at, what's happened this week. Step back and go, is it really that bad? Because last year, this is where I ended up. I'm only down about 3 or 4% from where I ended last year. Big deal, right? I made 25% and I'm complaining about 3. Come on, people. Just think a little bit.
Well, let me ask you this for the last question. If I'm someone, with hedging and with portfolios anyway, the younger you are, the higher risk, the longer runway you have. But if
Right.
I'm someone who's close to retirement or is retired and I'm trying to figure out, do I need to change up my strategy? I mean, what is the one piece of advice or the one input you would give somebody who is, on that more conservative end of the spectrum?
Well, now you're getting into something a little more specific here. I think right now you're going to be wanting to, and I know a lot of people have heard of these things, and but they're really really good. There are preferred stocks out there. Preferred stock. Go Google what's a preferred stock. Basically, what preferred stock is, and they have different rules. They can attach different rules to them, but just in general, say you look at a preferred stock on Boeing. I mean, everybody's heard of Boeing. There we go. If you get preferred stock on Boeing, usually that stock price is a little cheaper. It doesn't move very much, but it pays a dividend first and it pays interest. So you're not going to get the volatility out of this market that's going all over the place. It'll be very, very stable, and you pick up dividends and interest, and you don't have to worry. And you've got your favorite stock of Boeing. I love Boeing. And you got your favorite stock. Preferred stock is a great way to go. Some preferred stock, and you have to kind of read the freaking book that they give you if they give you one. Some preferred stock, you can actually exercise that preferred stock into real stock. They will allow you to do that, but you have to hold it for like 5 years or 7 years before you can do it, or it has to fall down to this price before it just all depends on what it is. A lot of them they don't do that. They just say, well, you're basically loaning us money, and for good faith of you loaning us money in this preferred stock, we're going to pay you interest and dividends and stuff like that before anybody else gets it. So, and that's really one way of getting away from the volatility and maintaining your portfolio with a lot without the ups and downs of the markets. And that's one thing that I would have people look at is looking at that preferred stock. If you're heading into retirement or if you're retired, to stay away from this, buy the preferred stock. Most of the S&P 500 companies have preferred stock. Now, you get outside of that, probably not, right? And there's some of them that probably don't. But I would say a lot of just the ones that you can think of off the top, when you go through the grocery store and go, well, there's Post and there's Kellogg and there's Campbell's and I mean, the things that have been around since dirt, right?
Yeah,
Those are going to
go with the greats because it's the wild, wild west out here.
Exactly. And so if you do the preferred stock, you can get the interest and dividends and you'll get a little movement in there, but you won't get near the volatility. But if you have if you have a stock, what moved Nvidia. Nvidia moved like a banshee right over the past couple of years until like what August of last year or whatever it was. It was up 400%. Well, if you had preferred stock in Nvidia, assuming they do, I don't know if they do or not, but just say you did. With that big of a move, you're going to make a lot of money off that preferred stock also. It's not going to go up 400%, but I bet you it'd go up a good 50, 60%, which is awesome. And when it's pulled back and when they do the stocks, your preferred stock is just fine. And that's the one thing that's really nice about preferred stocks. They will churn and churn and churn. They won't move as fast as the market. It's a slower pace. Another thing, if on a longer term basis, let me just say this, on a longer term basis, the markets are going up. Think about this. There are more up years than there are down years, right? And think about bear markets. Bear markets. I don't know. I mean, you probably weren't around in 1987. So,
I was.
okay. But you don't look like it. So, but anyway, back then, 87, 2000, 2008, COVID, think about all of those big bear markets, right? How long did they last?
Well, gosh, COVID didn't last that long at all. Almost feels
Nope.
like they get shorter and shorter.
Yeah. But you look at all those big bear markets, they didn't last that long. And in fact, if you just go back to one that most people remember is the financial, bank crash over in 08, 09, right?
Yep.
It lasted what? maybe 16 months, the bear market did. After that, we rallied from there. So on average, a year and a half in a bear market, and all the other years we go up. Well, that's pretty crazy. So, and if it's going to continue to do that, then by all means, why not? No, dabble in the SPY, and you don't have to buy 1,000 shares of it, but buy a couple of shares every now and then, and just leave it alone. And over time, it will pay you. I mean, you think about it, if you're right now retiring, let's just say at 65 or 63 and a half or 67 or whatever it may be, you probably still have 20 years in you. And I would hope. And so why not over 20 years have that increase in value? I mean, as the markets move higher. Yeah, there's going to be a year and a half in the little mix here that we go down, and there's the bear market, then we come out of it, and there we go again. But I would look at preferred stock and just looking at the ETF market and buy some shares of that overall. And overall, they will move higher. They will.
Yeah.
Gold and silver both. I mean, I think silver is going up to probably around 170. I think gold's probably going to hit easily 7,500. We just got to get through all the mess that we're in right now.
That's
And
from your mouth to God's ears, Geof. Let's just hope that's how it goes. But
yeah,
thank you so much for your time. I
you bet.
appreciate all of your insight. And then for everybody who has loved what you had to say, we're going to make sure we include your information in the description below. We love
Wonderful.
to hear everybody's ideas of how they're changing up their hedges too. And
Yeah.
always hit click, like, and subscribe.